Well, there's a lot of questions in there, because if you ask me what do I think happens in the next month, we couldn't possibly have a better economic setup, right? You've got growth holding in there. The consumer hasn't given up just yet.
Yep.
Inflation data globally just coming in, downside surprises every morning when we wake up, and a Fed that said, you know what? We don't even need a recession to cut. We're ready to cut even into this soft landing. You get support for equities, you get support for bonds, just about every asset class does well there. But remember your investment horizon, because we are still looking at a material slowdown in the middle of 2024. Recession risk is still elevated. And even let's just throw out that term recession. Stop thinking about, is it 2 quarters of negative GDP, 1 quarter of negative markets don't care as much as headlines do. We're going into a growth slowdown middle year. So this is a tactical Goldilocks, a nice air pocket that you can trade. You can also still believe there's a recession on the horizon. Two things can be true at the same time.
The people who are calling for a soft landing right now, what do you think they're missing? What are they not seeing in the data that maybe you are noticing?
Right. Well, there's a whole difference of opinion as to, and this is the core question, is this time really different? Because if you look at the wealth of leading indicators that have traditionally helped you forecast a recession, every economist knows those are flashing red. The difference between those calling for a soft landing and those calling for a hard landing is really how much of a factor do you apply to saying there are things at play that are different than past cycles that will mute or mitigate. And frankly, even those shops that are calling for mild recessions, and if you look at a list of consensus calls, it's either soft landing or mild recession. You don't have very many who are actually calling for a traditional deep recession, and you don't have very many that are calling for this re-acceleration in 2024. But if you look at that, what they are effectively calling for is that the Fed is easing a little bit. This time is different. It's going to be very mild. So this is really a difference of opinion, not a difference of data sets.
How important is the labor market here? Because the labor market has just been incredibly resilient here. And we even had a tick down in the unemployment rate last month, which I don't think many people were forecasting. It's kind of tough to have a slowdown in the economy if everybody's got a job and rates and wages are going up.
A job-full recession. We had the jobless recoveries coming out of the GFC. Now this concept of job-full recession. But there's a few things going on there. One of which is you don't actually need the consumer to be in a recession for the U.S. economy to have 2 quarters of negative GDP.
Okay.
That can come from housing, CapEx. Let's not forget, manufacturing is in a recession.
Yes.
Globally, we've actually had the longest manufacturing recession, one of the longest ever. So there are sectors and pockets of this economy, existing home
And
sales.
transportation companies will tell you they've been in a goods recession.
I don't have to convince anyone who's on the good side of the business. I don't have to convince small cap portfolio managers that we're in a recession. They believe me. And frankly, I don't have to convince anyone in Germany, Canada,
Right.
Japan, or outside the United States that we're in a hard landing. This is a U.S. story very specifically, and it's about services holding on. How much do jobs matter here? Well, one of the big challenges is jobs always break last, and they don't break in a linear fashion. It's a hockey stick. Forgive my Canadian reference. It goes hard and fast upwards. And if you take a look at some of this underlying data like continuing claims, if you look at that big drop down in vacancies, the risk is that the unemployment rate rises. Now, when you're an economist working for a bank or the sell side, you got to come out with a forecast. You got to come out with conviction. When you're in a role like mine, you work with portfolio managers every day. They don't really care what my point forecast is. They want to know what is the balance of risks. And the risk is not that the unemployment rate declines and the job market strengthens from this point. It's that the job market weakens, and it's really asymmetric risk going into 2024. Does it matter for the economy? Absolutely. But here I would say this is the difference between that mild recession, soft landing, and a worse recession. It's not about upside, it's about what downsides are not being recognized.
So then against that, what do you make of all of the Fed speak that we've seen recently? I mean, first, Powell kind of not pushing back on that idea that financial conditions have loosened. And then in the wake of that, a few officials coming out and maybe trying to walk back those expectations just a little bit.
Yeah, you know, we're always trying to get a sense of what exactly is the Fed watching, as if they sit in a secret room. Well, I guess they do have a little bit of a secret room, and they have this magic formula, and we're all just trying to guess exactly what that magic formula is. I don't think it's that at all. I think just like economists and strategists and portfolio managers factors, the weight that they put on different factors changes. But again, if I'm sitting at the Fed, what is the balance of risks? Here's a risk that I haven't heard anybody talk about: downshooting on inflation, sub 2% inflation. Why are we not talking about that risk when we see this material decline in inflation expectations, energy costs? There's a wide range of goods prices that are dropping really quickly. That's not my point forecast, but it's a risk that needs to be assessed and has to be taken into account by the Fed. At the end of the day, I don't know how much it matters why they pivoted. It just matters that, as I've been saying, the toothpaste is out of the tube. It's real hard to walk it back. And I hear every day, oh, but they're pushing back. They're saying they're not talking about rate cuts. Well, how come every day I turn on my Bloomberg terminal, and I see all the talk about how we're not talking about rate cuts? It's too late. And even, the ECB and the Bank of England, they try to push back as well. The market says, we don't believe you. We don't believe you because you get UK inflation this morning that just says you can walk that talk as much as you want, but the data is not supporting that we are not in a disinflation and growth slowdown type of environment.
Stepping back a little bit from a global perspective, how concerned are you about China? Because it's just been a lot of soft data coming out of China. The reopening wasn't what I think a lot of investors anticipated at the beginning of 2023. As you look forward to 2024, how do you feel like China is going to impact maybe the global economy, the U.S. economy?
Yeah, so we think about China in terms of fat tails. And by that, I mean that the distribution of risks on both the downside and the upside are quite large. So on one hand, as I said earlier, we're talking so much about soft landing, hard landing in the United States. The rest of the world is already in hard landing territory. Emerging markets led interest rates higher coming out of COVID, and they are now actively cutting. China is in a very significant fiscal and monetary easing cycle. We've got a range of emerging markets that are already in easing. The Fed and the rest of the developed market central banks are laggards when it comes. They will be the last ones to go. So following China through this disinflation, I think, is really clutch. And let's also remember, China is in deflation. They have negative CPI right now. So they are a really important leading story. What I think is telling about China is that they've put the pressure on the fiscal side to ramp up support. That's an upside risk to the global economy, but fiscal doesn't impact your economy overnight. So that's more of an upside risk to later 2024 into 2025. When you look at the lags between Chinese economic activity and U.S. economic activity, China's slowdown becomes very impactful to the United States in the next 6 months.